Silicon Valley has a dirty secret. While everyone's obsessing over ChatGPT and AI breakthroughs, the biggest names in tech are quietly doing something they haven't done in decades, borrowing massive, unprecedented amounts of money. We're talking about over $1 trillion in new debt by 2028. And here's the part nobody's talking about. 95% of companies using this AI technology are seeing zero return on investment. Zero. Today, we're re-exposing the dark side of the AI boom and why this debt bubble could make the dot-com crash look like a minor correction. For more than a decade, big tech has been defined by cash-rich balance sheets and seemingly limitless investor confidence. These were companies that didn't need to borrow. They had more money than they knew what to do with. But now, the rules are changing. As companies like Alphabet, Meta, Amazon, Microsoft, and Oracle race to build the AI infrastructure of the future, they're turning to a tool they once barely needed. Massive amounts of borrowed money, and Wall Street is starting to get nervous. Let me break down what's actually happening right now in credit markets. This year has seen a record-shattering run of corporate bond issuances from tech companies. Alphabet raised over $17 billion in the United States. When this much debt enters the market this quickly, it doesn't happen quietly. Analysts are warning about something they call supply indigestion, a moment when investors can't absorb new bonds fast enough without demanding higher compensation. Even when the bonds are coming from top-tier borrowers like Google and Meta, Morgan Stanley's analysts have highlighted something particularly concerning. Issuers are no longer sensitive to price. When the biggest borrowers in the world are willing to pay almost anything to push forward strategic AI projects, they distort pricing across the entire credit market. Think about what this means. Smaller companies, cloud providers, former Bitcoin miners who've reinvented themselves as AI hosting firms are now piling into the market too. They don't want to miss out, but their plans often hinge on aggressive build-out timelines and lease agreements that promise big returns at some point in the future. The problem, as analysts put it, is whether markets can stomach so much lower quality supply tied to a sector whose long-term economics remain very, very uncertain. And that uncertainty is quietly growing. Here's the statistic that should terrify anyone paying attention. According to an MIT study published this year, 95% of organizations using generative AI are seeing zero meaningful return on investment. Zero. Nothing at all. Let that sink in. Companies are borrowing hundreds of billions of dollars to build infrastructure for technology that the vast majority of users can figure out how to monetize. For lenders, the question is no longer whether companies can build the data centers. The question is whether they can actually ever monetize them, and some investors are already hedging that doubt. According to recent reports from Bloomberg, derivatives trading tied to potential tech company defaults is rising. This is a subtle but significant shift in sentiment. These investors are unpredicting collapse per se. They're simply acknowledging that refinancing risk becomes very real if the broader macro environment weakens. In other words, when trillions in fresh debt meet rising interest rates or a downturn in tech earnings as we've seen before, the strongest balance sheets start to feel the strain. So if the returns aren't there, why does demand for these bonds remain so strong? The answer is geopolitics and government backing. As I mentioned in my previous video on this subject, the AI industry is being propped up by truly massive government-driven investments. Governments around the world view AI not just as technology, but as a geopolitical imperative. Whoever controls AI infrastructure is believed to control the future of economic and military power. With global cash continuing to pour into fixed income funds, many buyers see these bonds as a rare chance to lock in exposure to the world's most profitable companies. Nobody wants to miss out, which is natural. Europe, where investors are hungry for high-quality U.S. tech exposure, is absorbing a growing share of these deals. The appetite seems insatiable, but beneath the optimism, a deeper shift is unfolding. Morgan Stanley's analysts have warned that big tech's financing strategy, taking on enormous amounts of debt without producing substantial returns, introduces a dynamic that credit markets have unseen in decades. This should sound familiar. It's exactly what happened before the dot-com crash. In the late 1990s, companies with no viable business models raised billions by promising revolutionary change. This time is different, everyone said. The internet will transform everything, and they were right. The internet did transform everything, but most of those companies still went bankrupt because they spent money faster than they could figure out how to make it. The survivors, Amazon, Microsoft, Google, only succeeded after painful restructuring and finding actual business models. Today's AI boom has the same dynamic. The technology might be transformative, but that doesn't mean every company borrowing money to build AI infrastructure will survive long enough to benefit from it. The difference this time is scale. The debt levels are larger. The companies involved are more important to the global economy, and the geopolitical stakes mean governments won't let them fail easily, which brings us to the real danger. Here's what keeps credit analysts up at night. Big tech balance sheets remain some of the strongest in the world. Their bonds are still considered exceptionally safe, but the sheer volume of supply, combined with the untested economics of generative AI, is creating tension across the entire credit market. A sector that was once viewed as a cash cow is now relying on leverage at a scale that rivals Wall Street's most capital-hungry industries. The risk isn't that one company fails. The risk is that when refinancing needs hit hand, the market might not be able to absorb it all. Spreads widen. Credit conditions tighten. Suddenly, companies that looked financially solid find themselves in trouble. And here's where it gets really dangerous. These aren't isolated companies. They're the backbone of the modern economy. Cloud infrastructure, digital advertising, e-commerce platforms. If they stumble, everyone feels it. On the surface, the AI boom promises extraordinary breakthroughs, productivity gains, medical advances, scientific discoveries that could reshape human civilization. But as the debt wave behind it rises as certainly rising investors are asking a more fundamental question. Is the future being built on sustainable foundations? Or is the world sleepwalking into the next credit bubble? The answer to that question will determine the fate of the US economy in the short term, and many global economies too. For now, the answer might depend on whether the billions poured into AI data centers eventually generate real returns, or whether, like so many technology manias before it, the promise of tomorrow is being financed by debt that the market may not be ready to absorb. Before we begin, a quick disclaimer. This content is for educational purposes only and is not financial, investment, or legal advice. Pension policies vary widely, so please always consult with qualified professionals. This video aims to provide a balanced look at the demographic challenges facing pension systems and is intended to inform, not to cause anxiety. We looked at how big tech is borrowing trillions to build out AI, even though the returns aren't clear yet. But another huge economic story is unfolding right now. Massive demographic shifts are putting pension systems worldwide under incredible pressure. Today, we'll dive into this pension challenge and see how it connects to the AI boom we just discussed. Let's start with the demographics, because the numbers don't lie. Back in the 1950s, the United States had about 16 workers for every retiree. Today, that number is less than 3. Government projections show it could drop to around 2.3 by 2035. The Congressional Budget Office estimates that the Social Security trust funds will run out of reserves around that same year. Now, this doesn't mean the system will collapse. After 2035, even without any changes, tax revenue would still cover about 83% of benefits. But it does mean that adjustments are definitely needed. At the state level, public pension systems are underfunded by about $1.27 trillion. States like Illinois, New Jersey, and Kentucky have less than 60 cents for every dollar they owe in future benefits. And this is a global problem. In Japan, the working-age population has shrunk by 14 million people since 1995, and pension costs are now over 9% of its GDP. France's pension spending is even higher, at 14% of GDP. And in China, the government projects its national pension fund could be depleted by the early 2030s without significant changes, thanks to decades of the one-child policy. The World Economic Forum has even estimated a potential global retirement savings gap of $400 trillion by 2050. That's a huge number, but it's based on a lot of assumptions, and policy changes could make a big difference. This means contributions from today's workers pay for the benefits of today's retirees. It's not like an individual savings account where your own money is set aside for you. This system works great when you have high birth rates, shorter life expectancies, and strong economic growth, exactly the conditions we had after World War II. The baby boom created a huge workforce, and people didn't live as long in retirement. But today's world is completely different. Global life expectancy has jumped by about 30 years in the last century. Birth rates in developed countries have fallen below the replacement level of 2.1 children per woman, and by 2050, it's projected that 1 in 6 people worldwide will be over 65. The math just gets harder. Fewer workers supporting more retirees for a longer time means you either need higher contributions, lower benefits, or later retirement ages. Just look at Japan's employment ice age. After their economy struggled in the 90s, many young people ended up in jobs without full benefits. Now, they are nearing retirement with very little saved, raising serious concerns about elderly poverty. How does all this connect back to the AI investment boom we talked about? It's connected in a few key ways. First, capital markets. Pension funds are some of the biggest investors on the planet. They need safe, steady returns, and they traditionally buy a lot of corporate bonds, including from tech companies. As tech giants issue tons of new bonds to fund their AI projects, it could push down yields. This forces pension funds, which are already underfunded, to either accept lower returns or take on more risk. It's a tough spot to be in. Second, demographics affect everything. An aging population can mean slower economic growth, which hurts both AI companies looking for new markets and pension systems needing investment returns. Finally, these systems are all interconnected. Many big investors hold both pension obligations and corporate debt. If the economy weakens, companies might struggle to pay their debts, which hurts the pension funds holding that debt. At the same time, any cuts to pension benefits would reduce consumer spending, creating a negative feedback loop. These are potential risks, not certainties, but they show how intertwined everything is. If these problems are so well known, why haven't they been fixed? The short answer is politics. The main solutions, raising the retirement age, cutting benefits, or increasing taxes, are all politically toxic. We saw it in France last year. The government raised the retirement age from 62 to 64, and the country erupted in massive protests. Why? Because for many, pensions are their only source of income. Cutting benefits directly impacts their ability to survive. On the other hand, younger workers are already squeezed by housing costs and student debt. Asking them to pay more in taxes for a system they doubt will be there for them is a tough sell. And shifting to a system where everyone funds their own retirement means one generation basically has to pay twice for current retirees and for themselves. Add to this the fact that older people vote at much higher rates, and you can see why politicians are hesitant to touch current benefits. So where do we go from here? Instead of one single prediction, let's look at a few possible scenarios. The first is gradual adjustment. This is the slow and steady approach. Retirement ages creep up a few months each year, benefits are tweaked through technical changes, and contributions rise just a little bit. Economic growth helps ease the pressure. It's a managed transition, not a crisis. The second scenario is crisis-driven reform. This is what happens when we wait too long. A recession or debt crisis forces sudden, painful changes. Benefit cuts are deeper, and social tensions rise. Think of Greece during its debt crisis. The reforms were necessary, but incredibly disruptive. The third, more optimistic scenario is successful transformation. Here, countries get ahead of the problem. They adopt automatic adjustment mechanisms tied to demographics, shift toward partially funded systems, and maybe AI-driven productivity growth helps save the day. It's a best-case scenario where we successfully modernize the system, and some countries are already making progress. Denmark, for example, automatically links its retirement age to life expectancy. It provides predictability and keeps the system in balance. Sweden reformed its system in the 90s, creating a model where benefits are tied to lifetime contributions and economic conditions. During the 2008 financial crisis, benefits actually went down slightly, but the system remained solvent without a political meltdown. Australia has a superannuation system where employers contribute to individual retirement accounts, which has amassed over $4 trillion. There are trade-offs, of course, but these examples show that reform, while difficult, is possible. Success often requires transparency, long-term planning, and a sense of shared fairness. When you step back, the AI investment boom and the pension challenge are two sides of the same coin. Both are testing old assumptions about growth, demographics, and returns. Can productivity growth from AI save us from demographic decline? Will those AI investments even pay off? How do we balance the needs of the young and the old? These are the huge questions facing us. Some are optimistic about technology, others point to the hard math of demographics. The only thing that seems certain is that the current path isn't sustainable. These are incredibly complex challenges with no easy answers. They involve demographic trends, technological revolutions, and political realities. Reasonable people can disagree on the best path forward. The key takeaway is that these issues are real and well documented. There are solutions, but they all involve trade-offs, and acting sooner is always better than waiting for a crisis. It's also a reminder that our own financial planning needs to account for these potential changes. The goal here isn't to cause panic, but to foster understanding. Ultimately, how we navigate these challenges will be decided through our democratic processes. What are your thoughts on all this? Which policy approaches do you think are the most promising or fair? Let me know in the comments below. For more in-depth analysis, check out my Substack and Patreon. Thanks for watching.